One of the interesting trades going into the back end of the year is what's happening with sterling. There's a divergence if you look at different currencies against sterling. But let's go first of all with the momentum that seems to be picking up on the downside against the US dollar, and begin with this aspect of trade for sterling as we talk to our guest today, Ron William from RW Advisory. Ron, welcome. Good to talk to you. I know that you've been looking at sterling and working out where we are now, where we're likely to be at the back end of the year, and how we look at 2022 as a trading year for the pound.
Well, the latest setback and actually the failure that started off just recently at the 140.42 price zone is likely going to be the overhang from now into the new year of 2022. Now, this was just recently triggered by a momentum demark exhaustion signal. But from a historical pattern point of view, it's quite interesting that there's a deja vu echo last seen in 2018 post-Brexit. So this is the same event, bearish sentiment, where the market has failed to break above this very important ceiling. And what it does suggest in terms of downside risk now and into the new year is a move beyond the current support at 134 into 131, which is an equilibrium value level according to different price analysis that I use. So certainly further downside pound versus the dollar, and as we'll see further on in our discussion, broadly speaking as well.
What about the growing macro divergences that you've got on here? Explain more about what's happening about the equity market risk and how you see that developing.
Yes, well, there are two charts inserts there on the right, and the first one, figure 2, it focuses on the technical signals based on options market sentiment using risk reversal. So many FX options traders will know of the indicator, and essentially it illustrates bullish bets on the dollar increasing versus the pound, which is what you see on the chart there going down, bearish pound, bullish dollar, but also bullish dollar, bearish euro. So we're seeing some, downside risk on the pound confirmed in the sentiment, but also a broad strength on the dollar in terms of sentiment and bets that traders are taking on board. Looking at the dollar index as a proxy, the key level there is 95. If we break above that, that would suggest further upside ahead. That's not my core view, but that certainly is a risk level to watch. And then the last chart that you just mentioned, figure 3, bottom right-hand corner, that's the kind of growing macro divergences weighed by the UK's trade deficit funded by portfolio flows. That has held up year to date, but it's relapsed just very recently. And so according to our cycle model, there is a risk for a correction in global equity markets going into the year end and new year. And if that were to happen on the MSCI index depicted in the chart, that would pressure further divergence lower for the pound.
In terms of the long-term picture, I'm always interested in your charts looking at these cycles. And I know that you've got your cycle applied to what's happening with sterling. What's it telling us for where we go from here and into next year?
Well, this is a blast from the past, both in terms of the big picture chart that we're about to see, highlighting a rare price and time confluence. It's also a chart that we're revisiting, Jeremy, if you recall, some time ago, we looked at this actually into the Brexit vote to try and predict what would likely happen in the market. Fast forward now, what we're seeing is that line in the sand at 140 still being important. It's a multi-decade level. It's very rare to see levels of this magnitude, and the market still respecting it and failing to break above it. So the chart that we looked at before is the same price level, 140 and previously 140, 142 is really an important pivot point for the market, and of course, one with historical weight. That is confluencing with a mid-stage cycle anniversary. So the 8-year cycle, which we looked at way back in 2016, again, the Brexit event risk of the past, is now chiming again on the halfway mark. And that usually signals a shift in sentiment. We can see there the bullish upside post-COVID then shifting this year into a failure recovery, and ultimately downside resolution with further risk to go. So that's what the price and time and ultimately the historical perspective shows. And interesting to make the point that this cycle does go back as far as the Bretton Woods, the end of Bretton Woods in the early 1970s. And it's still important now to just showing you how that pattern rhyme is relevant and suggests further downside into the years ahead. You can see there the cycle reset for 2024, according to this analysis.
Keeping this chart up just for a minute, just wanted to ask your thoughts on that next step lower. Are you talking about the next price target you've got is that Brexit low of 184? Is that your price target from this point, or are you talking about the Plaza Accord levels all the way down at below 110?
So Plaza Accord in terms of the range of this analysis going back that far, and also the fact that the cycle does coincide with major lows. So Plaza Accord, ERM crisis, TMT crash, GFC, and then the Brexit event that we spoke about. But in terms of, so that's the pattern rhyme looking at the cycles across history. But if we're looking at the price trajectory, so the previous chart highlights the key level at 131, 130, which is the tactical short-term objective that is likely ahead. But in terms of a big picture strategic level, I would suggest the Brexit area as being something to focus on if markets continue lower and remain under that 140 level. Again, that's the risk level. If we fail to really sustain any gains above that big picture level, then the downside risks become stronger. And let's not forget, we have been there before. Pandemic crash of 2020, we spiked into a new record low at 114.90. So been there, done that. We might not do it the same way, but certainly the risk is ahead.
Just wanted to follow up on a broader angle on all this, because you're talking there about sterling against the US dollar, which of course is one of the big crosses for sterling, and indeed one of the big markets that people follow. What about sterling against other currencies? Because it's quite often, and as I said at the top, there's some divergences we'll talk about against the euro particularly, I know, in just a couple of minutes' time. But let's talk about some of these other currencies and how sterling is performing against them.
Yeah, so overall, the message is broad pound weakness ahead in the short term, but it will likely be a bifurcated performance. There will be leads and lags, and this is often the case across global multi-asset markets, but particularly in the FX world where liquidity is strong and volatility can really deviate quite a bit. Here we see on the chart on the left, figure 1, showing year-to-date performance across most of the G10 FX rates. You can see, broadly speaking, it has relapsed to the downside, but there are wide bifurcation trends in there. So we can see there the leaders on the downside is pound dollar in blue and pound Canada dollar. These are already negative year to date. So they're already below the zero line there. You can see the dash highlight. Catching up behind is the Aussie, Swissy, and Euro versus pound, so pound weakness against them. But if we look at the chart in isolation, on the right-hand side, we can see there below the long-term 200-day average and above, pound dollar, Swiss franc, and Canadian dollar, again against the pound, trading below their long-term average, whereas pound euro, pound yen, and pound Aussie are actually holding above or trading near. So it isn't a one-size-fits-all. Do look for those leads and lags for some trading advantage. And probably the most important rate I would highlight here is pound against the euro.
Well, let's pick up on that, because that obviously has a big significance around how Brexit is working out. And let's face it, we are still trying to find some levels around which to play Brexit, because I know that as of the time of speaking, there are some fears that we're going to get Article 16 triggered around the Northern Ireland Protocol. And of course, there are a number of issues still really to be resolved, despite the fact that we've got all of the treaties effectively in place. You mentioned Brexit at the top in terms of sterling against the US dollar, but let's take a look in some more detail about sterling against the euro, because I know your views on this are particularly interesting, and this is something where a big divergence could, I know, play out.
Yes, absolutely. And so at the heart of technical analysis is the behavioral element of investor sentiment, and how that is often a lead proxy for the perceptions, in the market, but also even socio-political. So what we see here is a momentous breakout to the upside in favor of the pound versus the euro. That could happen if we actually sustain a break above 120. That's the magic level in this chart to watch out for. And what's interesting is, as you just mentioned there, with ongoing Brexit developments, which, by the way, does highlight the base formation that we have seen since 2016. This chart has been going sideways, locked in a range. Bulls and bears have been fighting both ways. And that's been very reflective of what's been happening on the ground in terms of the UK, Europe, Brexit developments. Now, right here and now, as you mentioned, in terms of event risk, Article 16, there's also discussions, I think even UK leadership spoke about potential suspension of the deal, and there's escalating trading tensions. Second to all of that, I would say, just in terms of economic hard data, Bank of England has just very recently suggested a hike in the near term. And so any modest reset in relative rate expectations between UK, Europe being quite bombed out at lows, would likely ignite this rate. So 120 is the magic line in the sand, and it's the 2-year resistance level right here, right now. That does illustrate the ongoing development of Brexit, UK, Europe for that time. And certainly if we were to break that, it would be momentous in favor of the UK if it's sustained. And just keep in mind that we do need to hold above the 200 moving average at 116.55. So long as we do, the risk is to the upside in favor of the UK. So not a one-size-fits-all in terms of pound weakness, and a potential divergence against the euro, and a very key proxy with this ongoing socio-political situations.
Ron, thanks so much indeed for taking us through some of the developments expected there for sterling against the whole basket of currencies, starting out with the dollar and ending with the euro. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.